Welcome back to another roundtable. My name is Adam. With me, Rizmin.
Hello.
Victor.
Hi, everyone.
Thank you so much for joining us today. We're going to talk about China ETFs. So recently, we've had some questions about, if I wanted exposure into China, but I don't really want to stock pick in China because I'm not too familiar with the companies there, but I still want exposure. What kind of ETFs can I look at to get exposure into China? And I thought that was a great question because sometimes, you're not too familiar with an industry or a sector, but you don't want to you're not confident in picking a stock, but an ETF gives you that exposure. And some of you may feel that way about China. So we're going to talk about China ETFs at this roundtable. All right. So we have a few that we picked up we think that are the best, and we'll discuss why we think they're pretty solid picks. All right. So let's go with the first one.
Yeah. Again, the first one is going to be the Korean Share CSI Chinese Internet ETF, and this is usually known as KWEB, and it's almost the equivalent version of QQQ of China. Right. So they focus purely on Chinese tech. Okay, so this is domiciled in the US, so it's listed in the US Stock Exchange. And if you look at the top 10 holdings, right, you're going to get Tencent, which the weightage about close to 12%, Alibaba close to 9.3%, Meituan, PDD, Baidu, NetEase, JD, KE Holdings, Tencent, Trip, right? So this is a natural diversification that you're going to get, right? Because they own in total about 33 companies, right? And of course, if you invest in KWEB, you must also bear in mind that there's an expense fees, right? So which is coming out to be about 0.69% per annum.
Which is on the high side.
Yeah, it's just slightly on the high side. And of course, this is the fees that you pay for that convenience, the diversification that you can get instead of building your own portfolio or doing some company. All this have the corporate action that you don't want to do yourself, like subscribing the rights. All this ETF will settle it for you.
Right.
Okay, so that's the advantage for that. Okay, so this KWEB, the reason why we bring it up is because they do provide the valuations, and I think if you look at the KWEB of all the companies in their portfolio in terms of PE and forward PE, all right, mostly forward PE is actually the lower side. Okay, so which means that it's actually a very attractive sector to be in, and that was actually partly mainly because of the last year we saw how Chinese tech really got whacked, right? I mean, we did talk about it a few times in the roundtable. And yeah, so KWEB is one of those ETF that you can consider. Okay, but caveat, because if you are foreigners, right, you're investing in the US, you own US asset, you are liable for the withholding tax of 30%, right? Which, I mean, the dividend payout for this ETF is likely going to be low. Okay, and there's also estate tax up to 50%. Right, we did talk about this as well.
40%,
before.
I think.
40%, yes. Yeah.
40%.
So this is a tier.
Yeah.
Okay. So if you don't want to have that kind of taxation liability, right? If you are afraid, of course, you can consider those ETF that domicile in the IREITs. Okay, but fortunately for Chinese tech, we do have ETF that are listed in Hong Kong Stock Exchange. Okay, and that will be the iShare Core MSCI China ETF, and this is actually by BlackRock. Okay, so they own also Chinese tech. Okay, most of them, like top 10 holdings, are your Tencent, Alibaba, Meituan, China, JD, Baidu, Ping An, okay, and Pinduoduo. Of course, they also own some of the financial holding companies that it's not a really pure QQQ of China, right? It's more like a S&P 500 of China. All right, so this would be the equivalent version of it, because if you look at the net asset size, the fund size of this fund is about 6.6 billion, which is very important factor for you to consider. Okay, you want to make sure that the ETF that you're investing are big enough, liquid enough, so that you will still be around for the next 10, 20, 30 years. Okay, so this is the fund that definitely going to stay. All right, and the management fee comes in at only 0.2%.
So a lot cheaper.
So basically, if you were to look into the Hang Seng Tech ETF, which this index that Rusmin talked is sort of like similar to the Hang Seng Tech, which also have almost the similar holdings, right? There's alternative like 3067, right? It's also the under iShare Hang Seng Tech. Then you also have another alternative, which is another Hang Seng Tech, but it's called it's 3032, right? But both of these, right, especially the 3032, right, the expense ratio is about 0.55%, whereas the iShare Hang Seng Tech is about 0.25%. So Rusmin, what he recommend on what he talked about on that, right, it's actually the cheapest in terms of the expense ratio.
All right.
Yeah. So the ticker symbol for this is 2801.
So this is listed in Hong Kong.
And you won't be subjected to your estate tax, or your withholding tax, because Hong Kong is known for that tax haven, status.
It's more tax friendly. So I think so far we've covered basically ETFs that kind of like focus on Chinese tech. Is that this is what we've discussed so far, right?
Yes.
So if you have KWEB, but that's listed in the US, and almost out in the US,
Yeah.
and the better option is the MSCI. What's the name again?
China ETF.
China ETF.
Yeah.
All right. So that one with the expense ratio at 0.25. That's probably
0.2.
0.2. All
yeah.
right. So that's probably the best one, if I put it that way.
And you are owning 7 over companies.
Okay, so it's super diversified.
Very diversified.
So KWEB is a bit more concentrated as
in
well.
the Chinese tech space.
Okay.
Yeah.
Yep.
So that's
and
what
the one
yep.
for the 3067 and the is about also, it's only 30 companies only.
All right.
Yep.
Okay. So again, not a recommendation to buy or sell anything. I think we've had a look around comparing the different ETFs. These are the things. These are the ones that we think are more interesting to look at. All right. So these are your your short list for Chinese tech. All right.
Yeah. And of course, there are also some people who are actually looking more like investing in Chinese A-share.
Okay. All right.
Right. So of course, there are also ETF because Chinese A-share is not easily accessible. Of course, nowadays they are opening up. You can actually invest in some of this Chinese A-share through the Hong Kong Stock Connect.
Okay.
Right. But where some people don't read Chinese or they just don't analyze Chinese market, right? Because it's a different world altogether, right?
The annual reports all in Chinese.
Okay.
Yes.
Right. Yeah.
And so the best exposure that you can get, of course, is just by simply investing in the ETF that owns a basket of A-share,
Okay.
purely in China.
So what do we have there?
What do we have? There are a lot of them. Of course, I would just focus on those that are listed in Hong Kong, mainly because of the exit tax or withholding tax that we just want to make sure that is taken care of, right? So the first one that I have is going to be iShare FTSE China A50 ETFs. Okay, so this will be the ETF that try to mimic the FTSE China A50. Basically, the 50 largest companies in mainland China, they are actually trading in Shanghai and Shenzhen Stock Exchange.
Okay.
Right. So you have big companies like Guizhou Maotai, all right, Contemporary Amperex, and then you have Wu Liangye, okay, China Merchant, BYD, and a few others, right?
Okay.
So again, this is the 50 largest company in China, but the number of holding they actually own is actually 90 companies, right? So and if you look, and this is also domiciled in Hong Kong Stock Exchange. If you look at the fees, it's only 0.35%, so which is quite reasonable for that.
Yep. So I have an alternative to that. Is also the iShare Core CSI 300 ETF.
Okay.
So that is basically the most liquid large and mid cap stock in the Shanghai and Shenzhen exchange, right? The only things that I see that's advantage over what Rusmi has said is that this ETF, right, have 301 stocks.
Okay.
Right. It's all the A-share, but generally the top holdings is the similar to what Rusmin had mentioned.
So this one is more diversified, 300
more diversified.
holdings.
Yeah.
That one is actually supposed to be 50, but you say it's 90?
90. So
Okay.
I don't know why, but basically that's what they put on their fact sheet.
But this 2846, right, is this ETF, right, they have multiple currency. So you can trade in Hong Kong, US or what. So the Hong Kong one is actually 2846 in terms of Hong Kong currency.
Yeah.
Right? But the management ratio, the expense ratio is slightly higher than the...
For the Hong Kong one?
Yeah, for this
CSI 300.
Yeah, it's slightly higher. It's about 0.38%.
The one that I just mentioned is about 0.35.
Okay.
Right. And this is under ticker symbol 2823.
Okay.
This will be the China A50. So it depends which exposure you want. You want the 50 largest company in China, then China A50 will be the one that you can consider. If you want the more diversified portfolio, of course, you can look at the iShare Core CSI 300, right, which is the 2846, where they own 301 companies.
It's kind of like the US Dow versus the US S&P 500.
Something like that.
Something like that.
Yeah.
Right? So this is for exposure into kind of like mainland Chinese.
Yeah, the A-share sort of like exclude those like tech companies like Tencent and Alibaba that's not in the mainland China.
Okay.
Yeah.
Right? But there's still some tech companies inside, but just there's more different type of industry.
Okay.
Right. Moreover, because the Chinese A-share, right, a lot of time they say the Chinese market is down, but they are referring actually to the Alibaba, the Tencent and all that. But in fact, since COVID until now, the Chinese A-shares has been holding very well.
Okay.
Yeah. So again, just to recap, right? So China A50 or CSI 300 doesn't own Tencent or Alibaba.
Yeah.
Okay, they are pure Chinese A-share. They are listed in Shanghai or Shenzhen Stock Exchange. Okay, and the fund size for A50 is a lot bigger. You are looking at about 17 billions in renminbi, right? Versus Core CSI 300, which is about 500 million renminbi, which is smaller.
Okay.
Yeah.
So the A50 is a bit more popular. Actually, a lot more popular. Yeah,
Yes.
a lot more popular.
Yeah.
All right. So that is what we have. So we have Chinese tech so far. We have China. I can say that.
Yes. Yeah.
And the last one is some people be asking about what about Hong Kong?
Yes, because most broker will give you the access to the Hong Kong market, right? And
Yeah.
I think the best ETF in Hong Kong is tracker fund.
Yeah. Okay.
Right, so this is the funds that mimic the Hang Seng Index, which they own about close to 76 companies in their portfolio, and the management fees comes in at only at 0.08%.
Oh, that's very low. Okay.
So it's the best, most efficient, I think, ETF that you can get in the market, and that will give you exposure to basically Hong Kong and China. Okay, so you again, the largest holding is going to give you the access to your traditional financial holding companies like your HSBC, insurance company, AIA Group, and of course your fintech companies or tech company like your Tencent, Alibaba, Meituan, right? And of course you also have going to own like Hong Kong Exchange, China Mobile, Ping An Insurance, and JD. Okay, so it's a mixture of financial, IT, consumer discretionary kind of holdings. So it's like, you know, the best of both worlds.
It's kind of like China, the best of China tech and some of the Hong Kong financials, which is very strong as well.
Yes, they are a financial hub, right? So that will gives you that kind of exposure.
All right.
Tracker fund.
Tracker fund, yeah.
And ticker symbol for tracker fund is 2,800.
All right. So basically, we have kind of like carved out China into three, which is basically China Tech, China A shares, and then we have Hong Kong Hang Seng.
Yes.
Right. So all this will give you kind of exposure into China. There are different ways to do it. So we've shared all the ETFs and the ticker symbols as well.
And of course, we also bring up a lot of Hong Kong ETFs, mainly because not because we want to promote Hong Kong ETF, but Hong Kong is pegged to US dollars, so naturally that will gives you that kind of stability. Of course, there's also always a risk that the pegging risk, right? But it's very low.
Yeah.
Right. So because government continuously stepping in to come in intervene the forex market.
All right. And it's great that it's always listed on the Hong Kong Exchange, domicile in Hong Kong as well, because then you can kind of avoid the withholding tax if it were US domicile and stuff like that.
Yes.
And the tax stays tax friendly as well, similar to Singapore.
Yeah.
Yep.
And if you look at the valuation for a tracker fund, which is basically your HSI index, you are going to get your PE, PB, PE about 10 times on average at the time of this recording. And your PB, you're looking at about 1 time. Okay, historically, the PE range for the HSI has been around 18 times to as low as below 8. Late last year when there was everyone was so negative about China, right? So now we are still at about 10. So it's still on the cheaper side. So
it's below average.
Yeah. So no matter what valuation that you use to value the Hang Seng Index, I think they will just tell you the same thing. It's cheap.
Yeah. So I think if you were to look at the HSI, which is the tracker funds that tracks this, right? You look at the current PB is about 1.03, right? And you go back to Asian financial crisis. At the low of Asian financial crisis, the valuation for Hang Seng index was like 0.99.
The PB, okay.
Yeah, so now the valuation for Hang Seng is at the valuation of Asian financial crisis.
Pretty much the same, yeah.
And if you look back to Asian financial crisis, at that point of time, those companies that was badly hit by Asian financial crisis, right, was like your Thailand, your South Korea, your Indonesia, your Hong Kong, and they are the worst hit, right? And Singapore is the safest among the rest, right? It was not affected. But in fact, after that, the next 20 years, right, the best performing are all these company, not Singapore. Even though Singapore withstand it very well, right? But the best performings are all these countries that was badly hurt at the point of time for the next 20 years.
I mean, the size of the economy probably helped, you know, the growth and all that.
And also is you get a very cheap valuation, right? So now you look back, we are back to Asian financial.
So what you're saying is
valuation.
basically it's very cheap.
Yeah,
at this
Asian
point.
financial crisis valuation, but the business since then and now has grown much stronger, and the situation is not like what happens in Asian financial crisis. Asian financial crisis is you don't know which company will survive. There's a lot of debt and all this. But the current situation is the debt level is still manageable.
Yeah. All right. So you have the valuation for tracker fund. You mentioned the valuation for KWeb as well.
KWeb as well.
Was it similar?
Similar based on their forward Ps.
All right. So I think we can all agree that when it comes to China at this point in time, it is cheap, still cheap. And if it's something that you're interested in, this is probably a good time to have a look at it. Again, it depends on your risk profile, whether you're comfortable investing in China. No recommendation whatsoever at this point, but we're just sharing the ETF options. So I think one question that could come up is that, should I or could I, use a DCA approach or dollar cost averaging approach to investing in these ETFs? What do you think?
Why not?
Okay.
Yeah, I mean, if you were to see that China has grown significantly throughout the years, right? And to date, they are already number 2 in the world, right? And the economy is getting stronger, right? As much as a lot of people keep mentioning that they are communists, but there's no doubt that the country actually grown itself, right? And the past 10 years growth is really quite crazy, I would say. And the way how China have changed throughout the past 10 years. So I think for the next 10 or 20 years, it's going to be very exciting for the...
And you've been to China yourself.
Yeah, I've been to China.
You've seen the changes.
I've seen the change. When I was there 10 years old, 20 years old, and I think 25 or 26 years old I went.
Okay.
It's totally different. It's really, really a big change on how they become very efficient, right? And how cash, cannot even use
Can't
cash.
use cash there.
Yeah, right. And they did it first before Singapore.
I find it really interesting because I was in Japan and it's almost cash everywhere.
Yeah.
Japan uses a lot of cash.
Yes.
Which is in Singapore, I hardly use cash nowadays as well. I'm just tapping everything.
Yeah.
But you're saying so China anyway is basically like almost cashless.
Yeah.
Yeah.
Right?
Yes. It's mostly cashless.
There's a saying that even the beggar on the street in China also have a QR code, which is quite amazing.
Yeah, I'm not surprised.
So again, that when it comes to question on whether should you dollar cost average or do a lump sum investment, it depends on how active you are in the financial market, right?
Okay.
If you are very hands-on, you do a lot of research yourself, of course, you lump sum would be a lot better.
Okay.
But for most people, right, I mean, if you are working, you're busy, you just want to exposure in China, want to invest in stock with Chinese exposure, dollar cost averaging will makes more sense because that doesn't just handle the valuation part, timing part, but also take care of the emotion part. Because the most challenging part in investing is that if you are lump sum investors, in the time like late last year when everyone was so negative about the market, you may hesitate to invest at lump sum. But if you do it every month, naturally you'll buy a lot of share late last year.
And some people could even look at China right now and they know it's cheap and they still have fear about investing in it. So, I mean, it's really up how you perceive or feel about things over there and whether you're comfortable with investing in China or Hong Kong.
Yes.
Yeah. So, even right now we know it's cheap, but some people just would not dare to go in still. Yeah. It's just the way it is. So, you
I mean, if you want to go in, if you want to have, exposure into the China market, right?
Yeah. So, anyway, your exposure for China wouldn't be as high as the US, for example.
Yes.
Yeah. So
you can do a bigger location for US or Singapore or your home market, right? Depending on where you are in, right?
Okay.
And then you have a smaller part on China if you're not really very comfortable or totally not.
I mean, you got to be comfortable to a level and then you just put some exposure if you want exposure there. So these are the ETFs that we've picked out. I think these are the more popular ones. Some of their expense ratios
are quite
reasonable
low,
as well.
reasonable.
Right? Very reasonable. Tracker Fund is extremely cheap actually.
Yes, it is.
And Tracker Fund has been around for a long time. Long time. And I mean, in the past, it used to be just Hong Kong companies, but then now you have Tencent, Alibaba, and the Hang Seng, which really gives you exposure into the mainland Chinese economy as well.
Correct.
Yeah. So these are the ETFs that we've listed. If there are too many for you to remember, don't worry, we'll put them down in the description as well, so you can go check them out. Again, no recommendation to buy or sell anything. This is just for you to do your research and find out more for yourself whether you want this exposure to China. And we hope this has been really useful, especially if you don't want to stock pick in China, but you just want some exposure. All right. So anything else you want to share, guys?
No.
All right. So I think that's a good wrap up. My name is Adam. Roseman.
Thank you.
Victor, thank you so much for joining us. Any questions about China ETFs, put them in the comment section. Of course, if you like this video, please hit the like button. Tell us if you're doing a good job. Of course, subscribe to our channel. Many more roundtables coming up, and we'll love to see you again.